That's why I said, are you ready? So hold on just a second.
Okay.
We got people coming in now.
Oh, okay. There we go.
Well, while everyone is coming in to join us, I'll just go ahead and start welcoming everybody. So welcome everyone to today's webinar. We've got Bruce Bischlein back with us, doing cash flow analysis, which is part of a larger financial series that we have. So if there's, let me see, the first one, Bruce, was bookkeeping, and then you covered financial statements, and now is the cash flow analysis, and you'll be talking about the cash flow statement. Right. So if you missed any of those other previous webinars, you can go back and actually find those on our Facebook page. But at this point, I'm going to go ahead and turn it over to Bruce so he can go ahead and get started, since we only have an hour with you.
All right. Thank you, Lynn. Welcome, everybody. I'm glad to see everyone here taking part of your day out to talk about the exciting role and topic of cash flow analysis and forecasting. Nothing better to do on a Thursday than to talk about cash, huh? Start off with, I'm going to just briefly say a few words about myself. I am a former business owner. I had a hardware store for 12 years. And so then after that, I spent 26 years teaching people how to start businesses and doing small business consulting. So I've been in the small business arena for well over 35 years. It's an arena I really, really enjoyed being in. But these series of webinars we've been doing, this being number 3, have been focused on pretty much the financial side of the business, because I have always seen that this is the side of business that most people do not understand. They're afraid of it for many different reasons, and there's nothing wrong with that. But in business, if you're going to be in business or you have a business, you have to understand the financial aspects of your business, because all these financial statements, balance sheet, income statement, cash flow statement, all of these are tools, and tools that show you how healthy or unhealthy your business is, can help you make business decisions, better business decisions, in order to make your business as successful as possible. So today we're going to talk about, I think it's most every business person's favorite topic, and that's cash. Understanding the importance of cash in your business. Cash is basically the lifeblood of your business. I've always likened it to, it's the gas that you put into your car. Just like a business, which is made up of many different things, many different systems, is just like a car. A car is made up of different systems. It's got the fuel system, electrical system, you got the drivetrain, all these systems that have to work together in order to make the whole vehicle go. But the one component that if you run out of, no matter how good all those systems are operating and functioning together, if you don't have gas, that you are dead in your tracks. And that's the same way with the business and cash. Uh, if you run out of cash in your business, you've run out of fuel, and meaning that you're basically out of business. So uh, that's the premise of what we're going to be talking about. Uh, I always like to say one thing: people talk about small business and big business. And there are obviously a lot of differences between the two. But the main difference between big business and small business is what we call access to capital. And that's meaning it, big businesses have better access to money, to cash, than small businesses do, but by the sheer nature of their size. Uh, so another thing that we talk about in business, and this is in any business, but specifically in small business, and that's business growth. Okay. Business growth is what we all in business aspire to. We want to grow our business. But what we have to understand that there's good growth and there's bad growth. And to really narrow that down, I'm talking about growing a business takes fuel, it takes cash, it takes money. Uh, Unplanned growth of a business, and I've seen this countless times, unplanned growth has destroyed businesses because they didn't have enough capital, enough cash in order to fund that growth. And you can grow yourself right out of business. Um, so to succeed, you have to understand how your business is doing from a financial perspective day to day. You have to accurately as possible predict what your future cash requirements will be. Uh, so in order to do that, you develop a cash flow statement to forecast, and then which is basically a plan of what your business is going to do cash wise in the future. And then you stick with that plan. So that's what we're going to talk about. Okay, it's not letting me advance, Lynn. Okay. So basically what we're going to look at here, we're going to first look at financial statements briefly versus reality. Balance sheets and income statements are wonderful tools because that's what they are, tools. But they do not always depict the whole picture of your business. You've got to look at some things in your business, i.e., the timing of how things are going in your business. Understanding not just how, but when cash enters your business, and then how and when it leaves the business. And that's what we're going to be looking at, is that timing factor. Basically, balance sheets and income statements are generally built using accounting accrual methods, meaning that you recognize a sale when the transaction is done. And that's not necessarily meaning the cash has been received yet. Same way with liability, you owe people money. when we talk about accrual accounting, that expense is recognized when incurred, not necessarily when it's paid. The cash flow statement is the tool that kind of factors in the reality, the timing of when these things are actually going to happen. Both tools, they seem kind of contradictory, but they're both needed for different purposes. And today we're going to talk about what I feel is one of the most important, and that's understanding how cash flows in and out of your business. Okay, next. Okay, this is to kind of give you an example of what I'm talking about. We're going to talk about this, a little exercise here, an example of accounting convention versus the reality of a business. And this is Crunchco, the balance sheet as of 10/31. On a balance sheet is a snapshot of a business at a particular point in time. And this particular one is on October 31st. So look at the left column, we've got assets. So we've got cash of $100. We have accounts receivables of $300. Accounts receivables are sales that you made, but you have not been paid yet. You have not received the money as of yet. But that $300 is not due for another 30 days. Now we have inventory of $600. So you add those together, we get total current liabilities of $1,000. So there are no long-term liability or assets here. So we've got total assets of $1,000. Okay. On the right side, on the right-hand column, is where we show the liabilities. Liabilities are things that you owe, money owed to other people. We've got a note payable to the bank, meaning you've made a loan and this is the payment to that bank of $200 and it's due on 11/1, which would be tomorrow in this case. You have accounts payable. Accounts payable are expenses you have incurred but not paid yet. So you look down here, we have payables of $100, but luckily you don't have to pay those for another month on 12/1. Then we have payroll due tomorrow on 11/1 of $100. So you add those three items together and give total current liabilities of $400. So at the bottom, you'll see the formula for a balance sheet is assets equal liabilities plus equity. So we can look at that knowing that we have total assets of $1,000. We've got liabilities of $400. Therefore, the equity would be $600. Owner's equity would be $600, knowing that the left column has to equal the right column. So let's do a little analysis of this. Next slide, please, Lynn. So what we have, we're going to do a little analysis here. These are three very common ratios that we look at when doing any type of financial analysis. The first is, these are what we call liquidity ratios, meaning liquidity means money, how quickly we can turn assets of the business into liquid money, into cash. So we're looking at working capital. And working capital is determined by subtracting current liabilities from your current assets. So the current assets in balance sheet we just looked at, $1,000 minus the current liabilities of $400. So that gives us a working capital of $600. Working capital, it just means that's how much money you should have to operate the business. So anytime you have a positive working capital situation. That's always a good place to start. Now we're going to look at the current ratio, and you determine that it's a ratio of your current assets to your current liabilities. And so we determine that by we take your current assets and we divide that by your current liabilities. And that gives so basically it's uh, giving us a current ratio of 2.5 to 1. What that means is that for every dollar that we have in liabilities, and that's every dollar we owe to someone or something else, we theoretically have $2.5 in assets in order to cover that debt. Uh, Generally speaking, any type of current ratio of 2 to 1, and this will vary by industry, but generally speaking, a current ratio of 2 to 1, meaning I've got $2 in assets for every dollar I owe to someone else. That is a positive situation to be in. Okay, let's look at the quick ratio. It's very similar to the current ratio. The only difference is we back out, we subtract the inventory from the current assets. The reason we do that is we want to see just how truly liquid this business is. So we're going to back out the inventory because it's having my background was in retail. My business ownership experience mainly was in retail. So I know that it is, whereas my inventory isn't current asset, I'm going to be selling it hopefully within that year. But I know I can't sell that inventory overnight very easily, unless I do it on pennies on the dollar. Even then would be difficult in a very short period of time. So we're going to back out the inventory. And in this situation, we're going to back out. So we're going to take out that $400 in the, or $600, excuse me, and leaves us with $400, and we have $400 in liabilities. Therefore, we have a 1-to-1 ratio, meaning that if I needed to get this money fairly quick to get my assets liquid very quickly, then I would be able to do that, because for every dollar I have in assets, I had that dollar to pay a dollar that I owed other people in the liabilities. So a 1-to-1 ratio in most industries is a good ratio. So, but here at the bottom, it says, but on 11/1, Crunchco has $300 in obligation that are due on the next day. But how much money did they have in the bank to pay them with? Well, they only had $100. So, this is an example where all the key indicators and ratios are telling me that this business is doing well. But from a cash position, is saying that I owe $300 tomorrow, but I only have $100 in the bank. So knowing this ahead of time would be nice, so that I could have an avenue with which to get the money I needed in order to not default on those liabilities. And that's kind of what we're going to be talking about here. Okay, next slide, please. So on an income statement, those accounts receivables, that you've given something away, your inventory or your service, in with a promise to be paid later, they're considered revenue by accounting convention, and a component of measuring just how well your business is doing. But in cash flow analysis, those receivables, because you have not turned them into cash yet, you have not been paid yet, are worthless until they turn into real money. Okay, Next slide, please. Now, this is a kind of a picture of cash flow activities. The top one says where cash comes from, and cash comes from three different sources: operations, investing, and financing. And you got to see how the cash flows into your tank, and it says in the tank, cash on in hand. And then you got the bottom, you got the cash flow outflow, and that's cash leaving your business. And it goes for the same three items: operations, investing, and financing. We're going to talk more about what those are. But if you'll notice one thing, which of those pipes is the bigger pipe? Well, the cash outflow is bigger than the cash inflow. So you got more going out than you have coming in. That is not real uncommon in business. Excuse me. Okay, next slide, please. Okay, these are the sources of cash. We talk about operating activities. We just saw the three, kind of define what those are. Operating activities that you get that are sources of money, obviously, are collection from customers. That could be cash sales, collecting on your receivables, things of that nature. Sale of a fixed asset that's an investing activity. These are things like, for instance, a good example of selling a fixed asset as a source of cash is when I sold my business. Excuse me. When I sold my store, I had a company truck pickup that I sold with it. Well, the gentleman who bought it didn't need that, and so what he did, he sold it because he had other vehicles that he could use. So he sold that pickup truck. The money he received from it, he reinvested it into more inventory in the business. That's a good use of selling a fixed asset because he was selling something that could be used in the business, but he didn't really need it. That is, as I said, a good example. A bad example is you sell the company pickup because you have payroll due on Monday and you don't have enough money to cover it. That's selling a fixed asset, something that you possibly could be using to help you do your business in order to cover a cash shortfall. So not such a good use of selling a fixed asset. Then we have long financing activity, and that's long-term debt. You go to the bank and you make a loan, a business loan, in order to start or to operate your business. It could be money from a bank, or it could even be a debt that the owner has loaned, money that the owner has loaned to the business. Okay, next slide, please. Uses of money. Here again, another operating activity is pay overhead expenses. Pay your rent, pay your employees, pay the light bill, buy supplies. Those things are just everyday overhead expenses, things that you need to do to operate. They use up your money. You're buying office supplies, that's using up the business cash. And the investing activity that uses money is to purchase fixed assets, that company truck we were talking about, any furniture, fixtures, equipment that is needed. These are what we call productive assets, what I like to qualify, I should say, as productive assets, assets that are needed to operate the business and will help generate cash in the future. Um, Financing activity, and that's repaid debt. You repay that bank loan. That's you're using money and to satisfy that in financing activity. Okay, next slide, please. So, how do you forecast? Especially if you are just starting a business, very, very difficult to do. Uh, Obviously, we're kind of looking to the future and we're making guesses, but that guess needs to be highly educated and a very thoroughly researched guess. Uh, that information is ascertained through market research, going out there and getting information about your type of business in your industry, uh, talking to other business people that are doing something exactly like or similar to what you're doing or wanting to do. Also, there's industry standards out there and different types, different sources where you can get this type of information. If you have an existing business you've had going for a while, you'll have historical data, hopefully, in some way, shape, or form, and you can utilize that in order to gather the information to do this forecast. If you've done a really fairly thorough business plan, including a marketing plan, that information will be there. And all you got to do is just pull it out and stick it in with the financial aspects. Next slide, please. So the process is very, very simple. You prepare the sales forecast from that information we got. How much you're going to sell in the future and when. You project where your cash inflows are going to be coming from. Sales, bank loans, other sources of cash, owner putting equity in, and then you determine, what are your cash outflows? What are they going to be, and when will that occur over the course of the next year in that 12-month period? Then you just put it all together. Sounds simple, doesn't it? Yeah. Not so simple, obviously, but that's what we're going to look at here in a minute. Okay, next slide, please. Okay, so why do you need to project this cash flow out there? Well, it will set some sales and expense goals. It will help you determine your break-even point, and that's what we're going to be talking about in the next session, which will be December 7th. We're going to talk about the break-even point and how to factor in break-even point, which is something that very, very few business people really understand that it exists, let alone how to go about determining what that is. Because break-even point is that point in the future where your business just begins to start making a profit. Wouldn't that, you think that might be a good bit of information to know and to have, is to know exactly when your business will start making a profit? Very, very helpful. And that's what we'll be talking about here on December 7th. Also, this cash flow projection helps to plan your business expenditures. I need certain amount, I need to buy a certain piece of equipment. When would be the best time to do that? I'm going to owe taxes at a certain point in time. When would be the debt? When am I going to have the cash available to do that? Am I going to have the cash available to do it when it's due? Most businesses have they follow a calendar year is their tax year. meaning that my fiscal year begins January 1 and goes through December 31st. When I ran my business for a while, I determined that my taxes were due, the corporate taxes were due in March, or not April, they were due in March. So what I did, that time of year was just coming off the worst part of my year. For my business, February and March were just, generally speaking, the worst when it came times of the year when it came to cash flow. So what I did, I went to the IRS, because you can do this, and I requested that my fiscal year would be from October till October. That way, it would put my taxes due in January, which is right after the Christmas season, when I had, generally speaking, my best cash flow and cash available. So if you know these things, you can plan these things, make these types of decisions. Also, it determines, the cash that you will need for supply purchases, inventory purchases, especially if it's a seasonal business type of business, which all businesses have seasons to some degree. They're all businesses are seasonal. You have your up times of the year, and you got the lower times of the year. I know my hardware store definitely had those cycles of good and then not so good times of the year. So you can, if you know that, it can help you plan your cash flow, and when you need to kind of cut back, or when you need to buy inventory, things of that nature. Do you now, or will you need financing? And if you will need it, when in the future? I've had clients who we understood that they're going to be, their business is extremely seasonal, and so they knew they'd have to stock up on, have some expenses this time of year, and wouldn't really get paid for it until later on in the year. So putting together a cash flow projection really helps. It really helps you understand the timing of all these things that are going to be going on in your business. Also, it shows lenders, should you need to go to a bank or get some type of loan, that you have the ability to plan your business, and to show how you can repay that debt. It just monitors your business as you go forward. Okay, next slide, please. Okay, this is kind of an example. I know this is going to have to squint a little bit here, but this is an example. There's 3 slides here that we're going to be going over. This is a cash flow forecast of Kathy's creation. She had this business for several years that she did part-time, but now she's looking at this year, she wants to take it full-time and see what it is. So basically, she does have some history, but we're also going to extrapolate into the future some things that we know that are occurring, and from her past business experience. But it just kind of, what we're doing, we're building a picture of the reality of this business in the future. So we've got we projected out cash sales and for the year. Then we know about what those cash sales, what it's going to cost us to produce that product and to sell it. So we have your cash purchases, and that's mainly for inventory and some supplies. Then I have rent. She's going to decide to move it out of her home and move it into a facility that had more room for her to create all this. So we have rent, then we have the telephone, got to have your phone, had some shipping expenses, and then advertising, had advertising expense. Then professional fees was just getting her business formally set up. Then we had some bank charges. That's the bank, what the bank charges on discount rate when you use credit cards or accept credit cards. Then you had some miscellaneous expenses there. Then down there we have owner's draw. She decided she needed to, in order to live and keep her standard of living, uh, because she was going to have to quit her day job, or at least cut back on it to part time, and she needed $2,000 a month out of the business. So then we have sales tax payments, and that's pretty much it. Then below we have her opening cash balance was she had $3,000 that she could put into the business. Well, as you can tell, there's a whole bunch of red there at the bottom. Now, remember, this is something we're doing this, we're looking into the future. We're looking over the course of the next 12 months. So we painted this picture, and there at the bottom, we painted in a whole bunch of red. Red means those are deficits. For instance, you got your uh, total payments, and then you got your cash surplus or deficit. Those basically are overdrafts. You're looking at your bank account. So obviously, that particular situation was a little bit too red there at the bottom to really be feasible. So next slide. Okay. On this example, what she did, we looked at having her do a $25,000 loan. This is basically what they call a working capital loan. And it is a 36-month loan, good for 36 months, pay it back. And that'll come into when we look at the loan repayment down at the bottom. So everything stays the same here. Sales and purchases, all that, and rent, everything stays the same, except that down here at the bottom is on down, it says loan repayments, and there was figured out, amortized it over the 36 months, and it's $800 a month. So there you had that's what it's going to cost her every month to get that money and start repaying that debt. So down there where we have opening cash balance, because we have the $25,000 loan, starts out with $25,000 in cash, basically. So we look through there, and lo and behold, there's still quite a bit of red down there. So especially on the closing balances, they're at the very bottom line. They're in month 9, 10, 11, 12, closing cash balances were all negative. So there's basically overdrafts at the bank. Next slide, please. So here we determined that, okay, a couple of things,
Did I go too far, or is this it?
No, that should be it. That's just,
Okay.
yeah, there was only 3 slides with the spreadsheets on it.
Okay.
I can't see that. It should say example 3 up there by the cash flow forecast. I've got stuff in the way that I can't see it.
Yeah, it does.
Okay, we're good. We're golden. So the only difference we made here on this one was, number 1, no rent. She decided she's not going to rent the place. She was going to keep doing the business out of her home. And 2, no loan. She's going to see if she can cash flow this thing by herself with the business. And now this is the toughie: no owner draw. She took away that $2,000 a month. So There's no owner draw. And if you look at down at the bottom line, except for month 9 and 10, you had deficits of like $1,300 and $245. And that's not so bad. So we understand with these stipulations and these changes, this business becomes more viable. Now, you're sitting around going, okay, but what if I needed those other things? Well, some things are going to have to change. And we're going to talk about what some of those things are. Okay, next slide, please. Okay, now what we all that red we saw on all of those examples was what we call cash flow gaps. That's where your inflows and outflows really don't match up. You obviously have more going out than you have coming in. So you've got to do something. So how do you fill those gaps? Well, there's only 3 ways you can do that. They have to be filled by some type of external financing. And number 1 is trade credit. If you're buying all your inventory or your supplies to create your product with cash, you might want to look at going to your suppliers and saying, hey, can you extend me 30 days credit? Now, this can help with your cash outflow, but it's a very, very short term type of financing, like 30 days is it. Because you extend them much beyond that, and guess what? They're not going to sell to you until you catch up. Obviously, you can go for a bank loan, and it could be a short-term loan, meaning you pay for it in less than a year. I did that in my business a few times. I had to go in there and said, "Hey, I've got some cash flow issues going on. I need to make this small loan for like 90 days, then I can pay it back, short term." But I had a relationship that I had developed with my bank over a number of years, and they knew that the business was viable and could repay the debt, or it could even be a long term. That's something that long term is something you're going to pay back in over the course of 1 year. But some type of loan from a lending institution, bank or whatever, could be a credit union, different things. Another source is equity infusion. This is money that is put in by the owner or possibly some investors. All of those are different, and you start talking investors, it gets kind of sticky when it comes to when and where payback on that is. But it is a source of funding. So whenever you prepare this cash flow forecast like we just went through, hopefully you can see how helpful it was in looking ahead and predicting where there could be some possible cash flow gaps and what you could do to correct those. And also, it just tells you the viability of the business going forward. Okay, next slide, please. So you have what I call the cash flow blues, and there are a lot of different causes. These are some of the main causes. Your fixed costs creep upward. Fixed costs are those costs that go on and you owe and will have to pay whether you make a sale or not. For instance, I owe rent on my space. My landlord couldn't care less if I make a sale or not. All he wants is his check every month, first of the month. So overhead costs can go up. Variable costs are out of control. And this is not uncommon. Variable costs are those costs which go up with your level of sales and go down when your sales go down. Perfect example is inventory. When my sales will go up, I'm selling more inventory, therefore I have to purchase more inventory. When my sales are down, I'm not buying inventory unless I'm not very good manager of my business. I'm not going to buy something that I'm not going to be able to sell or not be able to sell very quickly. So we've seen this here since the pandemic and with our rate of inflation, that these are costs that we have no control over. And they go up and you just have to, roll with the punches or not. We've seen a lot of businesses here in the last year or so have gone out of business because they fought this stuff, the lack of business during the pandemics, some of them, not all of them, but some of them. And then added costs when they were trying to get back up to speed and they just didn't mesh. And they just were not able to stay ahead of that curve. And it finally just ate them. Also, sales that convert to cash way too slow. Basically, what we're talking about here is if you're selling your product or service with accounts receivable, then meaning that you're giving them your product or service to some way, and all you're getting from them at that time is their promise to pay you at a later date. So, a lot of businesses are cash businesses. I had a retail store, hardware store, and which is historically a cash business. But I had to do business with the city, the schools. There were different manufacturers in the area. There were different trucking companies, oil companies, and that did a lot of business with me. They don't operate on a cash business basis. Therefore, I had to extend them terms, our 30-day terms. They come in, charge it, I would bill them. So I had receivables. As much as a third of my business was on receivables. So you have to learn to manage that, keep on top of it, because even though your terms are 30 days, that's not what they're always going to pay. So you have to stay on top of it. So if you see that your receivables aren't turning over as quickly as they should, then you need to really look at it and determine what you can or cannot do, or whether you should be, if it's a particular customer, it reaches a point, you have to make a decision. Do I keep them and keep hoping they'll pay me, or do I cut them off? It's all part of the decision-making process of having a business. Also, your inventory could be bloated. You've got unsaleable inventory for whatever reason. Maybe if it was fashionable, now it's not. Then you've got inventory that you can't sell or sell very quickly, or you've got too much of the wrong kind of inventory. These create things that you've got inventory. That's cash tied up in a thing that you cannot sell. So you've got to liberate that cash some way, somehow, in order to get that money. It may not be all you wanted out of it, but get it back flowing into the business. This last one, original capitalization too small. This is probably one of the most common causes for lack of cash in business. What I mean by there that a lot of business do not have enough cash or access to cash from day one when they open the doors and start doing business. They are what we call undercapitalized. Don't have enough money to get them through the point, get them through to where their break even occurs and beyond, to where their business starts to make a profit. So very, very common, and it's generally speaking, it's due to very little or no planning of any nature, especially financial planning. Okay, next slide, please. Okay, so there's four basic business rules. Number one is cash is king. You've got to have cash, as we talked about. You're out of cash, you're basically out of business. Or I should say, you're out of cash, no access to more cash, you're out of business. Uh, Cash comes from your customer. Don't ever forget that. It seems so common sense, but how many of you done business with a business, big or small, that acts like you're an imposition to them? So uh, that's why customers are always number one, because that's where your cash comes from. You must have more cash entering your business than leaving the business. I mean, this is common sense, but a lot of business people, for some reason, kind of gloss over that thing. You must know how quickly your profits are converting into cash. And this is, again, mainly if you're having to offer terms to your customers and you have accounts receivables. Okay, next slide. Okay, before taking questions, if there are any, I want to go over a couple of things, is how you can improve your cash flow. Um, Number one is to adjust your selling price. There is very little wiggle room for most of us in there. Uh, in retail, when I had my store, if I wanted to make more money, have more cash, I couldn't just raise my prices. It just doesn't work that way because I have competition that I have to look at and deal with and understand. But I've known a lot of my customers, my clients through the years, they sold their products, especially if they made them themselves, they sold them for too much, too little, excuse me. The service they offered, they did not charge enough for what they were offering. I had a client many, many years ago. I was talking to her about this. She made hair bows. Ooh, yeah, I don't need them. But she did excellent work, made a great quality product. And I told her, I said, you need to charge more. You're not charging enough for the quality and how good they are. And she looked at me and she goes, yeah, but I don't want to make too much profit. And I looked at her and I go, listen, there's no such thing as too much profit. If you start making too much profit, let me tell you, your customer will tell you because they'll quit buying your product. Okay. So don't want to hear anything about making too much profit. Uh, Also, sell more for cash. If you're allowing receivables, maybe cut back on that. Try to get cash whenever you can. If you have receivables, reduce your terms. Try to get that money quicker. If you are buying from a supplier who gives you 30 days terms and you're paying in 15 days, stop that. Use their money for that additional 15 days. Uh, Here again, when you're buying from your supplier and they give you 30 days terms, that means you're using their money for that 30 days. Utilize that. Don't don't cut it in half and pay them in 15. Uh, Reduce your overhead expenses, wherever you can. Cut back on expenses because I have found that, especially in retail, there's two ways you make more money. Because, as I say, you just can't go up there and raise your prices. You make more money by buying better. If you're selling inventory, you get the best price you can uh, from suppliers. If you're providing manufacturing a product, your supplies that go into manufacturing it, buy it at the best price you possibly can. Um, those types of things. Uh, Buy better, lower expenses, lower your overhead expenses, cut back on whatever you can, because all of those are money going out. What you got to do, that pipe, remember that big pipe of outflow, you got to make that pipe smaller so you got less going out whenever you can. It's called managing your business. Monitor your advertising and any associated costs. If you're advertising or paying for advertising that is non-productive, stop paying it. Stop doing that. Set budget. Budgets work. If you budget for this and that and stay within those parameters, you're going to do, generally speaking, do better off. So that's been a quick rundown, I realized, on cash flow analysis and forecasting. But I've got some time, be willing to take some questions if there are any.
Well, there was one question, Bruce, and it was from Tasha. And she was asking about the slide that had the 4 business rules. I'm going to switch. Oh, where was that?
Yeah, no, it's on towards the end. It's after there. Yeah.
So Tasha, I don't know if you had a specific question about it, but that's the slide you wanted to look at again. And if anyone does have a question, you can just type it over there in the chat box or raise your hand and I can actually unmute you so you can ask Bruce a question. Okay.
Yeah.
Okay. She didn't have any questions, Bruce. She was just
Okay.
taking notes.
Okay, that's fine. But those physical rules, they're pretty common sense oriented, but it's amazing how people we kind of forget common sense sometimes when we get right smack dab buried in our business.
Bruce, Sheila Smokey has a question. She asked, is there a particular formula for pricing handmade things to allow for maximum earning?
Oh, that's okay.
And you happen to do handmade products too.
Yeah, yeah, I do. Okay, let me tell you, probably the overall answer to that question is this, and I've said this for years and years and years. In any business, I don't care what business it is, one of the hardest things you're going to encounter from day one until the cows come home, for however many years you do that business, the one thing you're always going to fight with and try to understand and deal with is pricing, because pricing is, it's just there's no formula. You can go look at industry standards, like in retail. I know I need to make this type of margin on these products, but it's still a guess because it depends on your competition. It depends on, your customer,
Well, and when you're making handmade items, it
and
can depend on a lot of things.
yeah, and I
You're a woodworker, and I'm sure there are some famous woodworkers out there that could sell their pieces for thousands of dollars. And that's how I see it a lot when it comes to handmade products is, it's about the quality, it's about the perceived value by the customer. That's really where the price comes in, is the perceived value.
Yeah, very much so. And that's what I was getting ready to address was handmade products are really, really difficult. The problem of it is, to me, people say, well, sometimes you can do this, but most times on some, especially with what I do, I can't sit there and go, okay, I want to make $20 an hour, and it took me 8 hours, or it took me basically, or longer. It took me 16 hours to make this thing. Well, you know, yeah, I can't sell it for what that would be. Uh, so what you have to do is you have to determine, no, no, look at, as Lynn said, look at the quality of your product as compared to other places. Like my client who made the hair bows, she made hair bows that were tough to break. Okay, they were quality. But here's the problem. Uh, you know your product and the care and everything you put into it, but customers don't see all of that. They see a hair bow at Walmart for $10 and you're charging 20. They don't see the difference quality as a rule. So it makes it very difficult. It's very difficult. I wish there were a formula, but there really isn't. It's what I call whatever the market will bear. You just have to try some different things. Try different places. Try different uh, price marks. You know, different types of things.
And Sheila, I do actually have, like, if you're going to be selling on Etsy, I created a pricing formula. Bruce
That's
actually
right. That's
helped me
right.
on it. And I'm happy to share that with you along with the little video that walks you through and explains it. And it's something I created for the people who are selling on Etsy.
Right.
But kind of like Bruce said, you do have to kind of come up with, well, what is my time worth? Because there are things that I make that, like Bruce said, my time is worth $30 an hour. And that's why I don't like to sell things like my moccasins or my baskets, because I cannot, no one's going to pay me $30 an hour for
Yeah.
those. Um, and so those are things that I typically just, give as gifts, do for family. Um,
Right.
but then there are some items that I create that I can charge enough, uh, to make my $30 an hour. And so those are the items that I sell.
Exactly, and that's what you have to. It it's product driven. I do some of uh, my carvings. I put a lot of time into it. They take a lot of time, and if I kept, if I wanted to make $30 an hour, I'd have to start selling some of them for $600, and it's just not going to happen because they're not museum pieces. Uh, but at the
Well, I
same.
beg to differ because I think you're pretty good.
Well, thank
And
you.
you
I
make
appreciate.
you make a really nice eagle feather box too.
Yeah. But there's these things you have to just try. And what I always do, here's one thing I will say when it comes to pricing, and this is what people don't seem to understand. It is a lot easier to lower your price than it is to raise it. Okay. And it's like Lynn said, there is what we call perceived value. This was an example I always like to use. Back when I had the hardware store, I sold hammers, obviously, um, and I sold professional grade hammers, uh, and the cheapest one at that time, this was 30 years ago, was like uh, you know $20 on up. Well, I had people come in and housewives. I just needed hammer to keep in my drawer there. They don't need $20 hammers. Or some guy coming in and saying, I'm going to use this once in a while. So I came in, I bought some import hammers back then, and which wasn't real common in those days. And I put on a price on them of $4.99, $5. I couldn't sell a one. They sat there and sat there. So what I did, I went in there and I raised the price to $9.99. And within a few days, I sold out and had to reorder. They were too cheap. perceived value. We all do it. Most of the time we do it almost unconsciously. We look around, oh, look, there's two products that are are basically the same product. One of them say $3, the other this one's $4. Nah, the $4 one is more expensive. It's got to be better. We do it not out loud, but we do it up here unconsciously. So it's trial and error. Is what it boils down to. But like I said, easier to drop your price than it is to raise it.
Any other questions? And Bruce actually does counseling for us. So if there's anybody that, ever needs Bruce expertise, he's definitely the financial guy. We're more than happy to hook you up with Bruce and pay Bruce for his time to help you out.
Be happy to.
All right. Well, with that, Bruce, I'm going to stop the recording and wish everyone farewell for today. And I'll send all of you the webinar recording as soon as it's processed.
Thank you. I appreciate you all coming.